How does deflation increase your debt burden? Imagine a world where prices keep falling and your paycheck shrinks at the same time. It might sound good at first, but it can actually make paying off debts much harder. When prices decline over a period, it is called deflation. This situation causes the real value of your debts to grow, even though the amount you owe stays the same. Think of it like this. If you owe $1,000 today, that amount does not change just because prices are falling. But if your income drops by 5% along with prices, it becomes more difficult to pay back that same $1,000. This is because the money you earn now is worth less in terms of what it can buy, but your debt remains fixed in nominal terms. The term nominal means the actual dollar amount, not adjusted for changes in prices. So, as prices fall, the real burden of your debt increases. This effect is called debt deflation, a term coined by economist Irving Fisher during the Great Depression. He explained that as deflation happens, the real value of debt rises, making it harder for borrowers to pay back what they owe. Many people and businesses find themselves in trouble because their debts become more expensive relative to their income. When debt becomes more burdensome, people tend to cut back on spending and investment. This reduction in demand can cause the economy to slow down even more. Banks also suffer because, as more loans go unpaid, the value of collateral like homes or cars drops. This leads to tighter credit conditions, making it even harder for others to borrow money. Governments face challenges too. Even if they keep the same amount of debt, the economy shrinks, and the debt-to-gross domestic product ratio increases. This means the government has to work harder to manage its finances, which can lead to higher taxes or spending cuts. People tend to save more and spend less during deflation because they expect prices to fall further. This behavior reduces overall economic activity and can create a cycle where falling prices lead to rising debt burdens, which then cause even less spending. This cycle is called a deflationary spiral and can be very difficult to stop without government intervention. In essence, when prices drop, the fixed amount of money owed becomes more expensive in real terms. Your income shrinks, but your debts stay the same, making it harder to pay them back. This increased debt burden can lead to more defaults, financial stress, and a weaker economy overall. That is why policymakers often try to prevent deflation or keep inflation at a moderate level to keep debt manageable and the economy stable.